So what's the best investment in 2026?
I think multifamily.
Multifamily real estate, man.
Multifamily real estate.
I've never met anyone who says, I wish I'd bought less real estate.
Sure.
2009.
Let me ask you another question. If you had the choice, stocks, ETFs, crypto, or real estate, which one and why?
Real estate, because all the other ones you mentioned are speculative and mostly paper assets. They're so liquid that they create volatility, and volatility on a portfolio is the thing that kills the miracle of compounding interest, right?
Yeah.
I think you got to be careful what market you're in. So it's not, I wouldn't say it's a blanket, just buy anything in any market. But I think in Kansas City, where we're based, it's not a market that over the last few years has gotten really heated. There hasn't been crazy rent growth, and there's also been limited supply. So I think in this market, whether you're doing ground up development, there just hasn't been a lot of it. Absorption has remained steady, but supply has dropped off about 70%.
Okay.
So I think that that's great for new construction, but then it also trickles down to existing assets where there's just not enough housing.
Okay. Now, how long have you been in multifamily?
I've been in multifamily since about 2020, so about 5 or 6 years. Before that, I was in residential and some smaller multifamily, but as far as the larger stuff, started kind of pooling money together from investors, started doing syndications about 5 years ago.
And say in the last 5 years, roughly, what do you think the net amount is you have made in that 5-year period being in multifamily?
Yeah, great question. When you buy these assets and there's a longer hold period, of 5 years, a lot of those gains are unrealized because it's IRR. I was just checking, we've paid out about $9 million in distribution so far. So that's net cash out to investor.
Right.
But there's a lot more coming, but it's inside those assets and it's growing and compounding, and then when we have exits, we have another one that's actually closing in about 30 days here.
Right.
Where there'll be another multi-million-dollar chunk going out to investors. A lot of these are long-term holds.
Sure.
It's not a get rich quick. It's buy it, it's add value, it's manage it, and then, look for an exit in 3 to 5 years.
Sure. So you mentioned Kansas City. Obviously, not everybody that's going to watch this video will be like, oh, I'll just go buy property in Kansas City. They're not here. They don't necessarily know the market, which is why I just invest alongside guys like you and I'm able to obviously get a chunk of that return. What about Kansas City allows it to outperform other markets? What are like the 3 things, if you were to give 3 things that Kansas City has that maybe a Detroit or a blue area like Denver or, LA wouldn't have?
Yeah, I think some of the top things is kind of like I mentioned before, the market dynamics of supply and demand. There hasn't been a lot of housing units like you've seen in the Sun Belt, like in Dallas and Phoenix and some of these markets where it's just flooded with, and they're still kind of absorbing them.
Yeah.
But it's hard, and you've seen negative rent growth in some of those markets.
Sure.
Kansas City has had 4% year over year, according to RealPage. It was 3.9% year over year rent growth, and that's the top in the entire country.
Right.
Of 50 different submarkets in the whole country. And it's not like it's extraordinary, crazy, but in this environment, when you have markets with negative rent growth because it went up 10% and then dropped 12, Kansas City has been very stable. So I think it's a good place to invest because of that. You don't have the wild swing. You have something that's a stable market. It's a red state. It has very landlord-friendly policies. It's a good family. Schools are great. Raising kids. There's in-migration. There's a very diverse economy. There's not one single sector in Kansas City that takes up more than, I think it's 15% of the jobs.
I've seen that.
And so a lot of diversity there, a lot of tech in-migration.
Right.
So there's just a few factors, but I think you can kind of look at it holistically. And the things we always look at is is the population growing? How are the landlord laws? Because that's going to be huge when you buy an asset. And then what's the supply that's coming on? So those would be my top 3 things.
Sure. Okay. Now, you're going to be able to participate in deals like this without being a manager, without actively having to work with tenants, without actively having to invest or do fix and flips or things like that. If you wanted to learn how to passively invest in real estate, I'm going to break down my personal strategy. We're going to get into that. I'm going to show you the type of deals that I personally invest in. I'll walk you through some of the numbers because you guys can get involved in these type of assets too.
After COVID, we saw a lot of multifamily deals go really bad because of floating rate debt, bridge loans, all that kind of thing. And you see transaction volume drop to 2008 levels, really isolated in that one industry where people just weren't able to get deals done and haven't been able to get deals done. Warren Buffett once said, when there's blood in the streets, it's time to get greedy. When there's fear in the market, it's time to get greedy. And we're starting to see transaction volume start to pick up a little bit.
We're at the beginning of that curve.
I believe we're at the beginning. I mean, if you just look at the data, that's the story that it tells. You're starting to see the Fed begin to lower interest rates. They're wanting to incentivize more movement. That's why I think there's a unique opportunity. We're in a pretty interesting window.
Now, how much multifamily do you have?
We've got over 290 million in multifamily assets under management right now at our firm.
And that's been for about how long now?
The OKIQ started in 2020.
Okay.
Aaron and I both, we've been doing real estate, multifamily, all that kind of stuff for longer than that, but our firm started in 2020.
Now, what markets?
We're primarily in the KC Metro, the Kansas City area. We do have a couple of assets down in Northwest Arkansas as well. It's only about 2.5 hours, but we're very hands-on and very active in the management and operations of all of our assets. So we're not looking to go all over the nation.
Why those two markets?
Well, one, we live in Kansas City, but, so we're only, we're right here in Kansas City. Our offices are here in Kansas City, and we're 2.5 hours by car down to Northwest Arkansas. But really, Kansas City is the #1 rent growth market in the country year over year for the last 2 years. When you've seen some of the sexier kind of Sunbelt cities where a lot of the overinvestment happened post-COVID,
Right.
those markets are seeing negative rent growth. Austin, for example, is one of the sexy investment markets for a long time. And they saw like negative 16% rent growth or something crazy like that. Kansas City is a stable market. I'm a firm believer in stable over sexy. It's like as you mature as an investor, it's kind of the same as you mature as a human being. When you're 18, 19, 20, and you're looking for a partner, somebody to marry, sexy really matters.
Yeah.
But at a certain point, you start asking yourself the question, like, does he have a job?
Right.
Like, is she emotionally okay? Those kind of things.
True. That's a hard
So,
one to find.
I don't-
The okay part.
At a certain point, your definition of sexy starts to change. Right? To stability matters more. And Kansas City as a Midwest market is an extremely historically stable market for a lot of different reasons.
So what would make somebody not able to make the type of returns that you can get in Kansas City in, say, the market they're in or another market? What are like some of the determining factors behind why you could maybe take 2 apartment complexes, 2 multifamily, and they look the same, they're the same units, everything's the same, but you've got one market here, one market here?
Yeah. I think you can find good deals in any market. It's just the overall market dynamics of the Kansas City metro area. One, it's one of the most diverse employment markets in the country, which is a very overlooked important factor in creating economic stability. Kansas City has less than 15% of the jobs are consolidated in any one industry or any one sector. So you contrast with that with like a Detroit, for example, and the automotive industry back in 2008 got asymmetrically hit. 50% of the jobs now are at risk or gone. Turned that economy into a ghost town, right, overnight because of the high concentration in one particular industry. Whereas in Kansas City, all the jobs are very diverse and are not all concentrated in 1 or 2 industries. If you have a 50% loss one year, then you've got to have a 100% return the next year just to be back at break even in square one.
Right.
And so the volatility, the drawdowns are so much harder on your portfolio than trying to maximize annual yield, right? And so if you look at it from that perspective, the fewer the falls, the faster the fortune. And real estate historically has because of its illiquid nature, right? You can't just buy it and sell it at the click of a button.
Right.
Because of that, it has a lot more intrinsic, stable value over time.
Sure.
Right. Barbara Corcoran once said, you don't wait to buy real estate, you buy real estate and wait.
Right. Exactly.
Because eventually, its value is going to continue to climb.
And that's the problem that a lot of these money managers have. We actually called 3 this morning, and I asked them a simple question. I said, hey, I have about a $3 million portfolio that I manage. I'm making about 25% annually. I don't pay a whole lot of taxes, but I'm not a financial advisor. What are a couple things that you could do to outperform what I'm currently doing to make money in my portfolio? We got crickets. We got no. We can't help you. We got, you're not getting that.
Well, I don't believe that we would probably outperform 25%.
Hey, my name is Ben.
Sam, you said?
Yes.
We don't reinvent the wheel here on the investment side. We're long-term focused.
The money managers that we're supposed to trust with money, that are the professionals that know how to do this, that make less than us, okay, probably in a year than what we do in a month, don't know how to do that. And these paper assets also, you're paying capital gains or you're paying income tax. The market has historically done 11% in the last 100 years, whereas I don't think there's probably too many real estate deals you've done that have only made 11%.
Right. Yeah, and that 11% is annualized. It's an average.
Right.
That doesn't count for the years where there's drawdowns.
Exactly.
Right. So it's also a misleading thing to say, oh, I can get 11% consistently stable every year. Like, this, the average, you wrote the book on it, right? The average financial advisor makes what, a little over $100,000 a year. They have no real wealth of their own. And I'm not knocking, they're not all bad, right? There's some of them that are good out there.
99 out of 100 are bad.
Right. I met a guy in Atlanta, for example, that actually loves when his investors come to him, his clients come to him and want to invest in private alternatives like real estate. He helps them be able to have their cake and eat it too.
Right.
Right. Pulls securities-backed line of credit against their Schwab account and use that to invest. All those kind of things. So there's smart ways that financial advisors could do it, but the challenge is that most of them I'm not saying all, but most of them are incentivized to sell products on their platform because that's how they make their living.
Yes.
They're not incentivized to help you maximize your return on investment.
Exactly.
They're also not incentivized to help you be in a de-risked position.
Right.
The reality is after 2008, you saw this hyper correlation from all the quantitative easing or the government just printing money.
Yeah.
And then you know, all of the buyouts, the big bank buyouts, all that kind of stuff. You saw this massive infusion of artificial liquidity into the market.
Right.
That creates hyper correlation where it used to be you could have a 60-40 portfolio in the stocks and bonds, you know, back in the Reagan era or something like that, where you had a diversified portfolio. So when one asset zigged, the other one zagged,
Right.
and you could have some scalable growth over time. But if you look at the charts and the data, all publicly traded assets right now, even REITs, a lot of people talk about investing in REITs, but REITs are hyper correlated to the stock market.
Sure.
Because it's a highly liquid paper asset that's not traded on the underlying thing that it represents, but it's traded on the perceived value of the piece of paper.
Yes.
And so because of that, everything moves together, everything's correlated in public markets, and you can't actually achieve diversification in public markets anymore.
Right.
You know, people talk about diversification, and financial advisors want to tell you, oh, you need to diversify and buy this ETF.
But they all move at all the time.
But what is diversity? You want stuff that zigs when the other stuff zags. And when all of it in public markets are hyper correlated, you don't get that. And so even if you own different assets, they still all move up and down in value together because of risk on, risk off behavior in public markets.
Right.
Hard assets, tangible assets, things that have intrinsic value are really the only way you're going to achieve any kind of diversification in the current kind of modern day and investor landscape.
That makes perfect sense.
Right now, the values that we are going to get stuff for, when we look back 2, 3, 4 years from now, it's like the most unbelievable time. You know, the last few years have been, you know, there's been some distress in the market. There's been pullback. Rates have been high. So values have kind of come down. So right now we're getting such value in the pricing that we're never going to have this moment in time like we have right now.
And rates just dropped, obviously, September 17th or whatever it was. So what do you think that does for multifamily?
Oh, because we have so much leverage on these deals.
Right.
We're taking such a huge loan amount, even like quarter point, basis point, save so much profit on the back end. I mean, even things that we were modeling 2 years ago, now getting term sheets for it, it's like $2 million more in profit that we didn't even estimate. And the proceeds that now we're actually going to get, and also when we're going to able to refi some of these value adds. So there's just a ton of meat on the bone, but then we're still below. We know prices are going to go up because that's just what happens in real estate.
And that's more return for investors potentially too, because they go buy a single family home as an investment property themselves. Their difference on a $2,500 mortgage compared to $2,430 with a 25-point rate drop is not much. But when you're talking about being an investor in a $100 million asset, that rate drop is a lot more for your, what we call DSCR, debt service coverage ratio, which drives your margin up.
And to be able to do this passively, because for me, you know, most everyone I work with, we all have other businesses that are our golden goose.
You're busy.
And to be able to make as good or better than a do-it-yourself deal, single family deal passively, I mean, that's what we all want. We want time, we want leverage, and to be able to multiply that, there's nothing better than multifamily with these group deals.
So the last question I would have then is, why not the stock market? Why not crypto? Why not ETFs? Why not a more traditional asset?
I want to multiply my capital, and just historically being able to see what can really multiply it, but also there's safety in it as well. I call these investments like battleships. It's going to take your capital from one safe harbor to the next. And it's just been proven out time and time again. At the end of the day, people need a place to live. That's the last thing they'll give up. Housing prices are so expensive for people to buy. So I want some of these newer, nicer assets to just live in. And they might invest. We have people that will rent and they'll invest in syndications instead of owning a single family home. So just everything's trending to this market to be incredible returns.
Makes perfect sense. Now we're going to walk some deals that I'm actually part of. You're going to learn why I also think real estate is the best investment in 2026. If you want to start investing in real estate, we're going to break down good deals versus bad deals. I'm going to show you the type of properties that I invest in, which me as an individual, I'm getting access to the same type of investments that institutional investors invest in. And I'm going to show you my personal strategy on how I multiply my wealth. You actually heard Wayne say it earlier. I multiply my wealth by 2 to 3x every 5 years, very strategically, and I repeat that process. It's not complicated, but I want you to know it. So we're going to get into that all in this video. We'll meet you at the properties. So this is a Class A property. We call this Brentwood. We're with our development managers right now that have built over 40,000 multifamily units in the United States. So these are the type of assets that I invest in. Now, like I said, I'm not an active investor. I don't have single family properties. And one of the reasons I don't have single family is because if I've got 5 doors and 2 tenants decide to not pay rent, I'm not in the cash flow. I'm going to have to service that debt myself and cover the mortgage. Now, when you have 10 tenants move out, 20 tenants move out of a 200 or 300 unit multifamily property, you're still cash flowing. So you as an investor, whether you're accredited or not, you want to be able to get access to the type of investments the big wealth managers look at and the banks buy, which is why we put the funds together that we do, so that you don't have to actively manage. You get the tax benefits, you get the ROI, you get the appreciation. And then for those of you that are new to real estate investing, you have something called depreciation. It's kind of like a tax write-off, right? And you're using components of the real estate asset to deduct against the passive income that the asset generates you. So we're going to go inside, look at a couple units here, but this is why I invest in multifamily with people I trust in markets that create high cash flow, high appreciation, and allow me to 2 to 3x my net worth every 5 years and repeat the process.
In black now. Black appliances are kind of in, I guess. I can't keep up on all the styles, colors. I hear the grays and the whites, which are super hot, like in single family homes, but also apartments. I've heard that's already on its way out. We're going back to the earth tones, the golds and the browns. But that's okay. You just follow the cycles. That's what people want, how they rent. Showers are actual tile. Sometimes if we're doing a 2-bedroom or 2-bedroom with the den, the master will get, full true tile, and then the others will just be a fiberglass surround. Yeah, it's really impressive.
So you've got a couple different ways you can invest in real estate passively, all right? You have what's called a 506B offering and a 506C. Those are your 2 typical ones. 506B means that you can be non-accredited, all right, and be able to invest in a real estate deal. 506C is accredited only. We do both. Now, I don't recommend usually that people start investing until they have at least $25,000 that they can actually deploy and invest. So if you have less than that, you need to accumulate. That's step 1. Now, there's a deal not too long ago. We just closed all the capital on it. We projected a 2.37x multiple on invested capital over a 5-year period. So that means somebody put in 100 grand, for example, was going to end up with 237. That's what we projected, right? So another deal we're doing where we believe we're actually going to hit a little bit higher than that. I've included a link in the description to the Capitalist Network. This is my community where we help you guys get access to deals like this. You can invest right alongside me. Now, we do oil, we do real estate, and there's reasons for both, because oil, you get a lot of tax write-offs against your earned income, and then real estate, you're getting those write-offs against your passive. So there's reasons to kind of do both, have both in your portfolio. Now, a couple things to know. We manage close to $300 million in multifamily. We have $0 lost to investors ever to this point, an average of 35% internal rate of return, okay? Just for you to get an idea, 14.4% means that you are doubling your money every few years. So to be able to have a 35% IRR means that we're able to do quite well in these investments. And some you're in for a few years, some you're in for 7 years, okay? So it just kind of depends. Before we go in and go show you a couple other parts of this complex here, this is what I recommend you guys take action on, all right? Step 1 is I keep my money where I make 8, 10, 11, 12%. I have other videos about this. I've included it in the description below, but I keep my money in gold and silver, stuff that outpaces inflation, stuff that hedges inflation. And then I use something called institutional grade high early cash value whole life insurance. There's maybe a few dozen advisors in the entire United States that sell this, but you can make 8, 9, 10%, even more than that on your cash value in your policy. And while it's growing at a higher rate, I'm borrowing at like 5%, for example. And then I use that leverage to invest in assets that appreciate, like oil deals and like real estate. Now, there's a couple ground rules I want to give you guys, and I'm going to include a few tips in the description as well, so make sure to read that. But not all markets can afford 2 to 3x returns, okay? So you take Kansas City, for example. It's the average of 3.9 to a little over 4% annual rent growth, okay? It's had the best rent increase out of any market in the entire United States. It's also recession resilient. No job sector makes up more than 15% of the economy. So if you look at a place like, say, Detroit, where it's heavy manufacturing, or LA, where it's heavy in factories and fashion and things like that, if you have another COVID, for example, it can really depreciate real estate because people aren't paying their rents and they're allowed not to, and people are out of jobs. So I go into areas where you've got high rent growth, high appreciation, and you have a demand. See, the supply of multifamily coming on the market here is not on par with the amount of people moving into the area. And when you still look at rates, even though they've dropped a little bit recently, a lot of people, the millennial generation, like my generation, and the Gen Zers, have to rent because they don't have enough income to buy the average home in the United States. And the average home price in the United States isn't even in a good area, okay? So you have a lot of people called absorption, going into multifamily because they need to rent. So I invest in those areas that allow me to be in a nice, secure asset where I know I'm going to grow, I know I'm going to make money, I know I'm going to be able to multiply, and I know I'm going to increase my net worth by 2 to 3x every 5 years. So you guys want to get involved in assets, you know you're going to be able to grow your wealth. What I personally do is I keep my money where I make 8 to 12%, and then I borrow against that for a lesser rate, and then I invest in assets like this, pay myself back, repeat the process. So it's really infinite banking on steroids, done exceptionally better than a lot of the other YouTube videos you're going to find on it, with an end-to-end solution. So we provide all of that inside TCN. There's a link to a 7-day free trial there. If you're brand new to my channel, make sure to subscribe, smash that like button, tap that little bell icon so you stay notified on all the wealth building videos that I'm dropping. And any questions, let me know in the comments. I reply to any good question, anything that's intellectual, and I'll see you guys in the next video.